Day, like Bloomberg.
23 seconds away from the opening bell. Good morning to you. It's Wednesday morning. Equities up by 0.75%. Equity futures on the S&P elevated, on the Nasdaq up by 0.4%. Small caps, big call from Bank of America's Jill Carey-Hall in just a moment on the small caps. Quite constructive relative to the large caps. We'll get to that call in just a moment. The Russell up 0.8%. Today's opening bell in New York. Switch at the board and get to the bond market. What a year it's been. The 10-year through 2022 up by more than 200 basis points. Through the curve, we've seen massive moves. The 10-year this morning, 363.97. Yields just a little bit lower by 4 basis points on a session. In the FX market, no real drama here. Negative 0.1% on euro dollar, 106.14. Crude, just short of 78, just north of it now, $78 on WTI. We're positive by 2.3%. About 22 seconds into the session, the equity market elevated on the S&P, up by around about 0.6%. On the Nasdaq, up by about 0.5%. One stock to watch, absolutely flying since yesterday afternoon. Nike, stronger than estimated sales, easing inventory concerns and pushing shares a whole lot higher. That stock is up by almost 13% at the open. Abby has more. Hey, Abby.
Hey, John. Well, yeah, big beat and raise out of Nike. It seems that some folks are willing to pay up for their favorite brand, even amidst the difficult macro environment. Now, relative to that sales beat, it was by almost 6%, $13 billion thereabout, profits of 85 cents. That is a 31% beat. The outlook they raised to low teens growth, and the sales growth on the quarter that they just reported, it represented 17% growth. So investors really liking this. But there's one area, most of the areas beat. North America by 9%. One of the closely watched areas, China, there was actually a little bit of a miss there. Their sales estimate fell by 3% to $1.79 billion. Some analysts, though, are saying inventories are a bit cleaner, so there may be some positive news out of that region looking forward. And you were mentioning those inventories. It's really interesting, John. So on a year-over-year basis, it actually jumped 43%. Management is saying it's a matter of perspective, that if you compare it to the 2021 low, that's why it's so high. But to that improvement you were talking about, days of inventory fell by 10 days to 106. So really pretty positive there. Now, it's interesting, John, into today, the stock heading to its worst year, going all the way back to 1993, down 38%. But with today's 13% gain, the best day since June of 2021, trying to chop away at that decline into the end of the year.
A big day of gains in store, potentially. Abby, thank you. Fantastic work. One more stock to watch. FedEx, another earnings beat. The CEO writing a statement saying the following: our results exceeded our expectations in the second quarter, driven by the execution and acceleration of our aggressive cost reduction plans. Kaylee on top of the story for us in the last couple of days. The good news, Kaylee, no September repeat here.
Yeah, that is definitely the good news investors seem to be clinging to today, with the stock up about 5% at the open. So eating into some of that 40% loss on the year through yesterday's close. Even though objectively this wasn't all good news from FedEx, they still are warning about a weaker demand environment, and their full year profit forecast did come in a bit light. They only see between $13 and $14 a share. Analysts were looking for $14. But we seem to be focusing more on the beat we saw in the second quarter, fiscal second quarter, when it comes to profit. Even though we got a beat on the bottom line, the top line actually did disappoint, and that is really what comes down to these cost cuts and also higher prices. That helped raise the overall operating margin. So let's just take a look at the Express business as an example. It is the largest revenue driver, so it's very important. Package volume there was actually down by about 12%, but revenue per package was up 16%. So it's making more money per package than a year ago, even though they are shipping fewer packages overall. And the same was true in the ground unit as well. So that weaker demand being offset by higher pricing as well as cost savings. FedEx had already told us 3 months ago they were planning for aggressive cost cuts. They now upped the ante yesterday, increasing their estimate of savings by about $1 billion. They are now targeting $3.7 billion in cost savings in 2023, John.
As Tom always tells me, companies adapt, and I guess that company is adapting. FedEx right now up by almost 6%. About 3 or 4 minutes into the session, equities elevated by 0.7% on the S&P, and the Nasdaq up by 0.4%. Here's the call from Bank of America. Jill Carey-Hall, sticking with small caps into the new year, writing the following: amid a year of two halves, we expect less downside risk for small caps relative to large caps near term. And once the market bottoms, that's typically the best phase for small caps. Jill, I'm pleased to say, joins us right now. So Jill, let's take it from the top. Year-end target, 4K for next year. But I just get the feeling, Jill, reading your research, speaking to Savita recently, that you guys and the team are de-emphasizing the S&P, the index level. Why is that, Jill?
Yeah, and thanks for having me. Happy holidays. I think going into next year, we're looking for it to remain bumpy. We think there's potential. The S&P 500 hasn't bottomed yet. A lot of the indicators we're looking at suggest that the lows may not be in. So, typically the market bottoms about 6 months before the end of a recession, and our economists are expecting that we're likely to see a mild one, in the first half and into third quarter of next year. So we think there's potential the market could bottom sometime in the first half, and ahead of that, we're in a backdrop where we don't think the mega caps within the S&P 500 and a lot of the big growth and tech stocks that have been the leadership are poised to be the leadership in the next cycle. We think a lot of that part of the market is crowded. We see liquidity risk for the overall S&P 500. So we think that you want to outdex rather than index. So own the market X the top 50, or own the equal weighted index, or own small caps over large caps. So we see better opportunities in pockets of the market.
Well, let's get to that underweight in tech. So this year, as you know, some of these names have been absolutely hammered. Meta down 65%, Apple's down 25%, Amazon down 49%, Google 38%, Microsoft down 28%. Some people out there, Jill, conditioned by what's happened in the last 10 years, to your point, who believe looking at those losses, this is a buy. The argument for is that we've got peaking inflation, we've got the peaking Fed story, that this is a buy, we've had a terrible year, they can do better next year. What's the argument against that?
Well, I think, we've seen fundamentals for a lot of these stocks deteriorate. If you look at just the NASDAQ relative to the S&P 500, for many decades, the relative earnings trend was a straight line up. And now, for most of this year, that's been trending downward. You've seen downward revisions or weaker fundamentals for a lot of these companies. Obviously, there's, regulatory risk to tech after being a largely unregulated sector. You have a lot of these stocks that have been more crowded. They outperformed for much of the last decade, but typically, as I mentioned, we found that what leads in one cycle is typically different from what leads in the next. So we favor some of the other areas of the market in terms of more traditional CapEx beneficiaries. We think CapEx spending will be more resilient this time around. A lot of the big tech companies are still spending on CapEx, so we would rather own the beneficiaries, some of the automation beneficiary stocks. So select tech, but many of the industrials companies as well. And we still see energy as well positioned. That's still a very, inexpensive, not crowded area of the market with attractive free cash flow, which is one of the attributes that tends to outperform later in the cycle as well as in downturns.
It's one of your overweights. Here are the others. So we've got energy, utilities, staples, financials. Now, going into a downturn can make the argument for utilities and staples. Then you find energy and financials in the mix. Now, Jill, I was reading the note you put out in the last week. This is not your mom and dad's recession. You guys believe the performance of those two industry groups in a recession is going to be better than it has been previously. Jill, can you walk me through the thinking there?
Sure. I think for energy, this is still an area that, surprised many investors this year. It went from being a forgotten sector to now a much bigger weight in the index. Investors are still very underexposed to the sector. We do expect oil prices to be higher in 2023, overall a higher for longer commodity price backdrop. And, as mentioned, a lot of these energy stocks have attractive free cash flow now. They're paying attractive dividends. So, dividend income is one theme that we favor for next year. So energy really fits that theme. Financials is now a much higher quality sector than it was going into the last recession. It's now one of the highest quality sectors within the market, paying income. So that's another sector that when you look at energy, financials, even though these are more cyclical sectors, they've actually seen their betas decrease a lot. So they're actually sort of the new low beta sectors, where if you look at tech, communication services, they've actually become much higher beta sectors, so you've actually seen a shift in terms of the risks within sectors within the market.
They're the relative industry choices. Let's talk about small versus large. I talked about it in the introduction. You like small. Is that because you're looking across the equity market, looking at what's anticipating the downturn right now? Do you see that adjustment moving further along in small caps relative large, Jill? Is that what you see?
Definitely. I mean, I think, when you look at valuations, small caps have been trading at, 12, 13 times forward earnings. That's, lows we saw during the global financial crisis and below many of the recent recessions. And when you look at that relative valuation multiple of small versus large, we're pretty much at the lowest levels we've ever seen outside of, briefly during 99 to 01, which ended up being a really great buying opportunity for small caps over the subsequent years. So I think they're largely discounting a pretty severe recession at this point. And in addition, we think they're poised to hold up better given some of the macro fundamentals that we see, services spending holding up better than goods spending. Small caps are more services exposed. If you think about CapEx spending remaining more resilient, as I mentioned earlier, we've seen all this underinvestment by corporates for a long period of time, and now there's a lot of tailwinds to CapEx, reshoring of U.S. manufacturing. We're seeing a lot of evidence of that actually happening. Corporates, big tech companies spending on CapEx. So smaller, more domestic stocks are the ones that tend to benefit from CapEx spending by corporates within the U.S. So we think that they're actually better positioned, and given the inflationary backdrop as well, periods of high but slowing inflation, like we saw in the mid-70s to early 80s, a Fed taming a backdrop of high inflation, that tended to be a very good period to own small caps.
Hey, Jill, this was really thoughtful stuff. Just fantastic. I know that the year end is maybe just 4K and it sounds boring, but beneath the surface, you guys have got some really interesting calls. Jill Carey-Hall there over at Bank of America. Thank you, Jill, and thanks to the whole of the team over at BofA for their work done in 2022. It's been fascinating to have that ongoing conversation. About 10 or 11 minutes into the session, the equity market's up 6 or 7 tenths of 1% on the S&P. Into the open, about 11 minutes into this on the NASDAQ, we're up by about 0.5%. Coming up, Elon Musk prepared to step down as Twitter CEO.
Basically resignation by remote control. I think he had a very good idea of what the outcome was going to be before he decided to actually put the poll on Twitter.
We'll have that conversation, plus closing out a tough year for big tech. We'll discuss with Michael Purvis of Tallpack and Capital Advisors. That conversation coming up shortly.
Was basically resignation by remote control. I think he had a very good idea of what the outcome was going to be before he decided to actually put the poll on Twitter. He's receiving some heat from his shareholders. He's not paying enough attention to Tesla. The performance of the stock has been terrible, so he really needs to refocus back where his attention is needed.
Elon Musk confirming he'll step down as the CEO of Twitter. The billionaire still planning on overseeing the company's engineering teams once he's found someone, quote, foolish enough to replace him as chief. This coming amid criticism that Twitter has been distracting Musk from his role as Tesla CEO. Ed Ludlow from London joins us now for more. Ed, I feel like I asked the same question because I can't keep up with any of this. What is the latest?
The latest is that he'll follow through with it when the right person comes along. We just don't have a good sense of when the right person will come along. Tesla shares really trading choppy at the open, were higher, then lower, up around 0.5%. That follows the biggest drop since October during Tuesday's session, and we're coming off a November 2020 low. The problem is that Musk is giving actually quite a lot of detail about the financial health of Twitter, but you and I have discussed over recent days and weeks that actually the sell side and the buy side are looking at these two stories. Twitter and Tesla are so closely intertwined. Musk got into a tussle overnight with a well-known fan of the company, Ross Gerber of Gerber Kawasaki, for example, and criticized him when Gerber said, can you just give us some clarity on what's going on successional at Tesla? When will you be going back to Tesla? You do go back to fundamentals, though. It's interesting to see the note from Mizuho in the last 24 hours saying, yes, Twitter's a part of this story, but we're starting also to think about the fundamentals, right? Consumer weakness in key markets like China and the United States. You have to remind yourself, Jonathan, this is a stock that trades at 33 times forward earnings. The Fed is still top of mind. And then you look at its performance on a year-to-date basis. As you know, this is a stock that's down 61% year-to-date. Much of that decline has come since October 28th when Musk closed the deal to buy Twitter. So we're still focused on this idea of key man risk, that Musk is distracted at Twitter. But it was interesting to hear him speak, and the audience can go on the Bloomberg terminal and read the story I've written this morning on some of the financials around Twitter, where he justified the sort of severity of the cuts he made. We just need a name, Jonathan. Who's going to take this off his hands? Who can work for Elon Musk?
And no idea. I mean, who could work for him? I think many people could. Who can do that job? That's the big ask. Ed, thank you. Just fantastic out of London. Stripping this out, trying to tease this out is really tough. Leadership, one issue, the macro backdrop. All the automakers are struggling right now. Higher interest rates, you've seen the damage that's done to this equity market. The S&P on pace for its worst year since 2008, thanks in part to monster declines in the FANG stocks. Some of the biggest weightings in the index, together shedding trillions of dollars in market cap this year. Talkbacker's Michael Purvis expecting the tech sector to remain under pressure. He wrote the following in his outlook. Many big tech companies which have had secular earnings growth are showing signs of increasing economic sensitivity. Their business models are facing new challenges. The quality of earnings growth for this key sector won't be as impressive going forward. Michael Purvis, I'm pleased to say, joins us right now. Michael, year end, 36.50 next year. That gets our attention. Walk me through why this is a different regime and we're not going back to the pre-pandemic playbook anytime soon.
Well, you talked about the big tech earnings there, and I do think that, like for several years, we've all been waiting for this point in time when you can't have a secular growth story last forever, right? At some point, you get to terminal market share, and you're going to take on more economic sensitivity, and you're starting to see that in some of these wonderful tech business models. They're still wonderful, great business models, but they're just, the consistency and the quality of their earnings are not going to be what we've seen, for the last 6 or 7 years. And you're starting to see signs of that in their earnings reports. And then, of course, there's idiosyncratic issues with some of these companies as well, Meta being exhibit A of that. But I think my broader, reason why I'm at 36.50 is really not that I'm predicting a recession, some, avalanche of horrible economic data. In fact, I think it might actually continue to sort of outperform at least bearish expectations. But I think what is happening here across asset classes is that, we've largely processed a lot of the COVID era stimulus in terms of its inflationary impacts, supply chains and all that. But there's new structural factors that are coming just as these things are starting to fade, and those include, a very different commodity story with very tight supply on both metals and energy. On the hydrocarbon side, you're seeing deglobalization, which is actually going to be in many ways very good for Main Street America, but it's also inflationary. And then of course you have your employment. Structural employment changes that has been, problematic for the Fed, and I think will be increasingly problematic for those that expect rate cuts to materialize in the second half of next year. So I think what I'm sort of saying here is that the earnings situation is not going to collapse next year, but you're not going to go back to see this, this really wonderful, uptrend in earnings. Particularly with some of the sort of moderate contraction in real growth and also inflation. And in some ways, I'm more worried about falling inflation hitting earnings than I am necessarily a recession there. So I think it's a lot of regime shifts happening all at once. And to get back to the, sort of the buy the dip that we've seen coming into last winter for so many years, I just think we're in a different era where the old economy is coming over, and then you've got new challenges. And so, inflation will continue to fall, but can we get to the 2% target by next December? I'm not so sure we can.
So, Michael, what I hear from you is that we're leaving behind a regime of structural disinflation and replacing it with a regime of structural inflation. Can you talk to me about that, how that shapes potential leadership in the equity market going forward?
Yeah, well, I think if you think what's driving that, some of these new pro-inflationary forces, things like deglobalization, that means you're going to see strong earnings from the industrial sector. I think the energy sector, even if oil prices don't get back to triple digits, are still going to be, outperforming on the earnings side. And look, I'm not saying Google's going to, earnings story is going to fall apart. Absolutely not. I'm just saying that the consistency and the magnitude of the earnings growth will not be what it is. It's going to lower Sharpe ratio for big tech earnings going forward, and that's, there's still a huge weight in the index, and so that process is a little bit more volatile. I think in some of the other sectors, look, banking may be big banks may actually do better than expected, at least on the net income margin front there. Retailers is very much a mixed bag here, with a lot of very, very specific challenges trying to sort through shifting consumer demands amidst some of the strangest supply chain shifts we've seen in some time here there. So, again, I don't think the earnings story is one at the index level is going to be a collapse, but it's not going to be a big expansion. I think it's sort of a sideways grind through next year and then into 24. And the problem is that you're still going to be in this two-way volatile market with a lot of tactical sort of tight moves there. It's going to be hard to be a long-term investor next year. It will be the opportunity set for agile traders is robust, but what we buy big tech and sit back and watch the index put up double-digit returns for 4 years in a row like we just had coming into last winter, that is just not coming back anytime soon, and I don't see what the path is to getting back to that, particularly with some of these sort of pivot points in the big tech earnings stories.
Well, this year was difficult, and from what I hear from you, the next year is going to be equally as hard. Year end, 23, 36.50. The call from Michael Purvis at Tallback, and really nuanced read from Mike. Mike, thank you, sir. Appreciate that, and have a fantastic new year to you as well. Coming up, we'll bring you the trading diary from New York. Stocks are higher. This is Bloomberg. Equities positive here. Let's get your trading diary. Coming up very shortly, existing home sales and consumer confidence at the top of the hour. President Biden, Zelensky holding a joint news conference at 4:30 Eastern. US GDP, core PCE, another round of claims coming up next Thursday. Durable goods, personal income spending numbers on Friday. Then we close out a week with you, Mitch. And I close out the year right now. So before I rush off for the holidays, special thank you for all the hard work that goes into this show. My team do a fantastic job of making me look good even when I'm really bad, and a special thanks to you at home. I say this a lot, I know. You've heard me say this before, but every time I say it, I mean a little bit more. You are the most intelligent audience on the planet. Thank you for making me sharp. Thank you for making me smarter. Have a wonderful Christmas and a very happy New Year.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, December 21st. Here are the top market stories who are following for you at this hour. Help wanted. Elon Musk officially searching for a new CEO as he tries to find someone foolish enough to take the job. His words. Zelensky's historic visit. Ukrainian President Volodymyr Zelensky arrives in Washington to meet the President Biden and deliver an address to Congress. We're going to get the latest. And from Bahamas to the U.S., Sam Bankman-Fried will sign away his right to fight extradition today, then head to the U.S. with an 8-count criminal indictment waiting for him. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, we have some nice read on data here coming in.
Yeah, I want to talk about the consumer for a second. Consumer confidence coming out from the Conference Board, 108.3. That's up from 100.2. The market was looking for 101. That's a really big number.
Yeah.
Present situations, 147.2. Take a look at what is happening with Nike today. That stock absolutely surging. Those numbers are really strong. Take a look as well at what is happening with Carnival. Carnival stock absolutely flying today. Really positive commentary on what's happening with future bookings. The consumer is not done yet, Alex, and I wonder what that means for the economy in 2023. People are talking about a recession. Doesn't look like it yet.
Well, that's the whole thing. It all boils down to what consumers are going to be spending on. I mean, Nike still has a huge inventory load, though. The difference is that people are willing to buy all that stuff on discount so far. I just wonder how they're going to offload. Let's get to some data that wasn't so great. Existing home sales down 7.7% in November. That's the lowest level that we've seen in quite a long time, since February. The biggest drop. And I should point out that this was when you had 30-year mortgage fixed rate above 7, so there obviously seems to be some correlation. That 30-year fix has come down. So will those existing home sales actually stabilize and come up? Not sure. We're going to break that down later with Mark Zandi, chief economist at Moody's Analytics guy.
Absolutely. Looking forward to that conversation. The perfect person to talk to on a day like today. I'm still reeling from that consumer confidence number. 108.3. That is a really solid figure. We'll work that into the narrative as we work our way through the next 2 hours. Let's talk about a couple of other stories that we're going to be watching very carefully over the next 2 hours as well. Some big geopolitical and crypto events taking place. I'm going to deal with the first one first. Ukrainian President Zelensky visiting the White House today to meet with President Biden. He's going to be meeting leading figures as well on Capitol Hill a little bit later on. There's going to be an address to the joint session of Congress. Remember, this is the first time that Zelensky has left Ukraine since the Russian invasion. That happened back on February the 24th. Joining us now to talk about this is Bloomberg's Anne-Marie Hordern to give us a sense of what we should be expecting here. Anne-Marie, what is he going to get out of this trip? This is a huge moment from him, huge security implications for Zelensky leaving the country, coming to the United States. He's obviously got a shopping list. What does this mean for Volodymyr Zelensky?
Well, Guy, in about 4 hours' time, he'll be touching down right here at the White House, and he'll be sitting down with President Biden. Obviously, he'll be thanking President Biden for his support. Actually, yesterday, when Ukrainian President Volodymyr Zelensky was in Bakhmut, a city in Donetsk, these soldiers there gave him a flag, and he had said he will pass it along to Congress and the U.S. President to give him our thanks, kind of alluding to his trip that is happening today. What is he going to get? We know is $2 billion more the president is expected to announce, or nearly $2 billion more, as well as that Patriot missile defense system. This is something Ukraine critically needs right now, Zelensky has said, because what they are dealing with is a barrage of missiles on civilian infrastructure. And what Putin is really doing going into the winter months is weaponizing Ukrainian civilians' access to power, to energy, to clean water. And that is what he's going to get today, and also make his case to Congress.
Yeah, well, that was what I was going to say is, Anne-Marie, who is his key audience when he's talking to Congress? Is it Democrats? Is it Republicans? Is it the American people? Like, what does he need to prove when he's giving that address?
I think his main individual that he would like to address, or the individuals he'd like to address, is that come next year, the Republicans will be taking control of the House, and those are the lawmakers he wants to make sure he has on side. We've already heard from the next Speaker of the House, most likely Kevin McCarthy. He said it. There's not going to be a blank check going to Ukraine. He wants some more oversight on that, and this is Zelensky's chance to explain to Kevin McCarthy, two fringes on the party, like Representative Marjorie Taylor Greene, who called him a shadow president and really disparaged his visit to Washington, D.C. to explain why they need the U.S.'s support. So this would be his moment. But I also think writ large he's going to want to address the American people to make sure that the constituents that these lawmakers represent agree and support what they're doing. You know, last time he spoke in March, it was shortly after the invasion, and Ukrainian headlines were making front page news every single day, and you saw the destruction that was happening from Putin's invasion. That has started to quell, and he's going to use this moment to remind the American people.
Anne-Marie, what is the risk for the United States in providing highly sophisticated Patriot missiles for Ukraine?
Well, Russia has continuously said that everything the U.S. is doing is basically means the U.S. is a part of this war, given the fact that they have been the biggest backer in terms of aid, given the fact that they have cut off Russia from some money, some access to technology, to a number of sanctions, including Russian individuals. We got another list last week of those. So Russia already thinks the U.S. is involved in this. I'm not sure the Patriot missile system, given the fact that so much of it is defensive, will move the needle for the Kremlin. But we did hear again from Putin today. He was speaking to a defense board, and he says he wants to make sure they are supporting the nuclear facilities that they have in Russia. So maybe potentially you'll hear more of this rhetoric coming out of the Kremlin.
Anne-Marie, thanks a lot. Really appreciate it. Great reporting. Bloomberg's Anne-Marie Hordern joining us. And we're going to bring you full coverage at 4:30 p.m. today when Biden hosts a joint news conference with President Zelensky. Another story that we're following today is a disgraced FTX founder, Sam Bankman-Fried, will be extradited to the U.S. We're waiting for that. He's expected to be taken into custody within the next hour after departing the magistrate's court. Want to get the latest on the ground with Bloomberg's Katanga Johnson joining us. Katanga, what are we expecting? What's the tick-tock for today?
This morning, we expect Bankman-Fried to leave the prison at Fox Hill Prison in Nassau and head to the magistrate's court, where he'll sign the final extradition papers necessary. There will be a brief hearing, we understand, at 11 a.m. Eastern. From there, he should head to the airport on the western side of the island and board a federal aircraft to head back to the United States. We understand that while what faces him in the United States are charges that have been brought by authorities there, the Bahamas authorities are still investigating, and it is expected that they will bring charges as well.
But once he leaves the country, presumably the investigation in the Bahamas is going to play second fiddle to that in the United States. It was always likely to be that case. How big a blow to the investigation that is taking place in the Bahamas is Sam Bankman-Fried's departure, Katanga?
Authorities here are pointing to a critical part of the investigations here, particularly around the assets that the company owned, not just FTX, but the group of companies here under its umbrella, including Alameda Research. Those assets, including land and property, apartments, penthouses, play a critical role in helping both creditors and customers retrieve at least some of their lost funds. So sources on the ground are making it clear that while, yes, the charges in the U.S. are more advanced, the operations and the investigations around their operations in the Bahamas still play a critical role in people potentially getting their money back.
Katanga, do we know why he's going to do this now? He's going to go to the U.S. A couple weeks ago, you can make an argument the strategy is to fight extradition for a while and just stay in the Bahamas. Do we know what kind of turned the tide here?
It was interesting early this week to sort of see a change in strategy between what we saw last week. It seemed as if the counsel for Bankman-Fried in the United States potentially negotiated a bail deal once he returns to the United States. That has not yet been confirmed by Bankman-Fried or his Bahamian lawyers, but we understand that that was a part of the conversation. Potentially, that is one incentive for him to change his strategy. But also, the relationships that protected him in the Bahamas may or may not have involved former government officials or individuals whose names once revealed about whether they received any special benefits or in some way were able to get their money off of the platform at a time when others didn't, could potentially change the relationship he has with people who protected him here in the country.
Katanga, fantastic reporting. We've really appreciated it. We continue to appreciate it. Thank you very much indeed. Bloomberg's Katanga Johnson joining us from the Bahamas. Coming up, we're going to push ahead into 2023. We've had some fairly solid corporate numbers today. What does that signal about next year? We're going to get a take from Linda Dussel, Senior Equity Strategist for Federated Hermes. That conversation next. This is Bloomberg.
The top names at the Fed are on Bloomberg.
I do see growth slowing, but remember that's part of the mechanism of getting demand into better balance with supply and alleviating those price pressures.
We're clearly not in a recession right now based on the data. It is an economy that is growing only modestly, and I think it's an economy that's really seeing the imbalances between supply and demand diminishing and inflation coming down.
Nobody covers the Fed like Bloomberg, your global business authority.
The lesson of 2022 was stagflation, bad for all financial assets. Even commodities started to catch the knife for a little bit here towards the end of the year. So I think as we move off the stagflation narrative, I think it bodes much more favorably. If we're wrong around that, and inflation is incredibly difficult to forecast, of course, but it does seem like all indicators point to lower inflation in 2023. I think the tail risk that we were experiencing in 2022 gets chopped off in 23, and I think that matters a lot.
That was Greg Peters of PGIM weighing in with his expectations for the year ahead. And that leads us to our question, which is, what's your top call for 2023? I feel like this may be our question for the next 3 days. Joining us now, Linda Dussel, Senior Equity Strategist over at Federated Hermes. Linda, good to see you. Basic, your top call next year.
I think next year's going to be a great year for bonds, high-quality bonds. And you can't often say that. It's usually the boring area. If you go to sleep at the beginning of the year and you wake up at the end of the year, you may find the stock market is flat, but lots of volatility in through the year.
Linda, the big thing around the stock market story for next year, according to most of the people I'm talking to, is that we are going to see a big hit to earnings. Yet I'm looking at numbers from Nike this morning. I'm looking at numbers from Carnival this morning, all indicating that the consumer is in fairly good shape. I'm looking at the consumer confidence data from the Conference Board. That is telling me that the consumer is in good shape. What happens if we don't get a recession next year? How out of position do you think most people's portfolios will be?
Well, as far as I can tell, consensus expectations for earnings is actually that it will grow next year. And we think at Federated Hermes that earnings will decline, maybe about 10%. That would be in conjunction with a mild recession, and that would be it would be okay if it's not priced into the market now. So we think, as what we see, is a lot of people are positioned defensively, but they also have a lot of cash still on the sidelines, and they're wanting to buy the dips in really in technology shares. They still are enamored with growth, and we think that that's wrong.
So that's an interesting point. So it all though boils down to how people are going to be spending their money, though, no? Because if we go to the inflation point, everyone thinks inflation's peaked out and that we're going to roll over next year, for example. But if the consumer keeps spending the way we're seeing it, and the expectations were pretty solid, does that throw that point out of the water? If we keep spending, that pushes up inflation, that makes the Fed have to go harder, and it pushes out a recession.
Well, yes, and again, I think 100% of us think there's this recession next year. It's a question just how strong it will be, how mild or how severe it will be. And we've been saying that it will be a mild recession, which is, well, we're around 0% GDP real growth next year at Federated Hermes. So that's a very mild recession. But it is true that both consumers and businesses' balance sheets are really still in quite great shape. And when we look at the consumer confidence surprises today, but I'm not sure why it should surprise when gasoline prices have come down fairly dramatically. There's a very close connection with that. People losing their jobs are able to find jobs elsewhere. And if you look at the top half of the income cohort, they're still seeing raises. And so their salaries are accelerating. Yep. It's no wonder they'd be in a good mood.
Yeah, but that all tells me that the Fed's going to have to do more, which makes me wonder, Linda, about the call on high-quality bonds. If the Fed's going to have to push harder, and the market's saying currently 5%, maybe is where we top out. Let's say that number is nearer to 6. Is the bond call still the right call?
Okay, so we don't believe that it's going to go that much higher than 5%, and I really don't think the market does either. You go to 6% if you still have an inflationary problem, and there are so many evidences that inflation is likely to plummet next year. The issue is not that it will come down hard, but what it will come down to, and that is where we're suggesting, much like the 70s, inflation was stubborn, you didn't make much money in stocks, that might be what next year looks like. The Fed can't cut all through the year, so it stays up at 5%. You can like high quality bonds and long bonds if the yield is high enough on the back end, and what we're saying is don't expect it to go much higher now. You know, it's up around 4% might be ideal, but maybe we want to start peeling in. Maybe we don't want to be too cute about when we start peeling into long bonds, which are much higher yield now than they were just a couple of years ago.
So a couple questions on that one. Linda, in essence, though, are you weirdly fighting the Fed with that? Even though I hear what you're saying in terms of they might have to stay longer, higher for longer, but by buying the long end, aren't you fighting them?
Well, by buying the long end, you're saying that inflation has peaked, and they're saying that too, and as I said, there's much evidence. To fight the Fed would be to say we're still early on in a tightening cycle, and we know that it's been the quickest tightening cycle in history, really. So, you know, you need to believe that inflation's coming down so they can slow down and then stop. And that's the evidence is that they're saying it's not a fight. We're all copacetic, and basically what we're saying is you have to be patient. There's not going to be, you know, a big wild moves. We're just going to plod along and be patient, and inflation will come down and it will stay too high, and you're not going to see the big hits to the consumer or the big hits to corporations. It's just going to be, you know, kind of there'll be volatility, but it'll be boring in the end, and then the boring group bonds is where you're going to probably make some money and not a ton either.
Linda, big tech's been battered this year. Why shouldn't I be buying?
First of all, I want to say that in my many travels, the most common question I'm getting is, what should I buy now? Everybody wants to buy growth. It's such a fun area is growth to invest in, and technology in particular, and that's where people are wanting to buy on the dips. So growth stocks, which tech is the poster child, they like low inflation, they like low long-term interest rates. You can say I see them coming down, but they're not going to be low. We don't believe it's a growth regime anymore. We believe now that you need to expect higher inflation. That is, you don't get to 2%, which is what the Fed wants. You get more like towards 3%, and much more pain if they want to get it to 2, and maybe they'll call victory at 3. All that being said, they're not inexpensive enough, our tech stocks. Yes, they got crushed, and they're not inexpensive enough to get back in. We like value.
Tech stocks definitely not under Linda Dussel's Christmas tree this year. Thank you very much indeed for joining us. Have a very happy holiday. Linda, thank you. Linda Dussel of Federated Hermes. Okay, still ahead, talking of tech, Elon Musk confirming that he will step down as the Twitter CEO. Who could take the reins? How is this going to work? We're going to find out next. This is Bloomberg.
time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Federal authorities will whisk Sam Bankman-Fried to the U.S. to face a range of criminal charges related to the collapse of the FTX crypto exchange. Bloomberg has learned that FTX co-founder will sign a set of extradition papers at a Bahamas court and take a non-commercial aircraft back to the U.S. escorted by FBI agents. And investors ready to turn the page on the worst year for equity since the global financial crisis should brace for more pain headed into 2023. That's the blunt message from top strategists over at Morgan Stanley and Goldman Sachs, as well as others. They're warning that stocks face fresh declines in the first half as corporate earnings succumb to weaker economic growth and still sky-high inflation, and as central banks remain hawkish. And Elon Musk says Twitter was on course to hit $3 billion of negative cash flow prior to the recent round of severe cost-cutting. Musk bought Twitter for $44 billion in October and has drastically cut costs, including laying off more than half of Twitter's staff, and has been confirmed that he will step down as CEO once an appropriate replacement is found. And that is your Bloomberg Business Flash. No mistakes, no fumbles. I win that one.
I think we all win that one. But yeah, well done. I thought whisk was a high point. I thought that was a tricky word to get in there. Going to whisk him to the United States. The producer's saying he's very happy with that. Let's talk about that Twitter story. Ed Ludlow, of course, has been writing about all of this, talking about the financials.
Right.
Is Musk admitting that he can't fix Twitter?
No, he's not. The opposite. You know, he's saying, I will step back as chief executive officer. I will continue handling engineering at the new look Twitter. This is like the playbook from Tesla and SpaceX. You know, you talk to anyone over the years.
Yep.
He's not your sort of classic management style CEO. He considers himself to be at the coalface, making real product and engineering innovations. That's part of the problem why we can't build a list of potential candidates, because he's talked about wanting this technologist type who understands servers. Why servers? Maybe because Twitter becomes more than just a social media platform. You need the compute power and data storage and also software. That person's got to be able to do that job alongside Elon Musk also doing that job. Very interesting.
Yeah, sounds really fun. Totally not up for that. Hey, Ed, what did we learn about Twitter's finances over the last 12 hours? The Twitter Spaces on this, for real?
Yeah, quite a lot actually. You know, in the middle of the night US time, Musk was pushed on what the kind of runway cash rise Twitter had, and he actually gave a pretty thorough explanation that, you know, had they not cut costs, they would have been facing this $3 billion of negative cash flow next year. I think what's interesting for me, and I looked at what he was saying, revenue of $3 billion last year. If you go on the Bloomberg terminal and look at the date before the company was taken private, Bloomberg consensus was for revenue of almost 5.9 billion or 5.2 billion, sorry, for that year. So something's clearly changed, but it appears the cost cuts at least have been effective.
Does that, though, make a mockery of his valuation for the business?
Yeah, I knew you were going to ask about valuation. You're not the first to do so. Well, I think Musk made multiple attempts to walk away from the deal. You know, at the time, a lot of people said there's no way that Twitter should be valued at $44 billion. The stock, when it was public, traded completely artificially because it was subject to a takeover bid. Its peers completely fell away in the weeks and months where that deal was negotiated. I'm not answering the question. It's not for me to answer.
Fair enough. Ed, good stuff. Really appreciate it. Bloomberg's Ed Ludlow joining us. All right, coming up, existing home sales falling for a 10th straight month in a row. We're going to get more insight with Mark Zandi, Moody's Analytics chief economist. I should point out, though, that stocks are at the highs of the session, up over 1% on that stronger consumer confidence data. We'll get more on that, too. This is Bloomberg. about an hour into this trading session. Nice jump higher here on that consumer confidence data. Also, volume not totally terrible. Abigail, do a little tracking those moves. Abby?
Yeah, good point, Alex. We do actually have volume on the day, above 5%, the average volume, the anemic volume, but nonetheless, that is a change, and we do have it on to the side of the bulls. To Alex's point, a very nice rally here. That S&P 500 up 1.2%, the NASDAQ up just a little bit less. Take a look at the stocks really outperforming, a leading TEL index, and then the banks also outperforming, up 1.9%. Now, it could certainly have everything to do with that consumer confidence data. It could also have to do with bond yields, because we have a little bit of a decline here. We're taking a look at one that we don't often look at, the 5-year yield, kind of the middle or the belly of the curve, as they put it, down 5 basis points, giving stocks a little bit of a breather, taking off some of the valuation concerns. We have that knee-jerk reaction, perhaps, of yields down, stocks higher, but it could also have to do with some great earnings reports that we have. Both Nike and FedEx put up really pretty good quarters. Nike in particular, they beat, they raised. The stock is up 12%. It's best day since June of 2021. Inventories improving. China missed, but there are some bright spots there, so investors buying in on the idea that consumers in some parts are really willing to pay up for their favorite brands. FedEx beat on profit, a little bit of a sales miss, but their outlook, and I should mention for Nike, their outlook raised better than it had been after withdrawing the outlook. So investors, again, helping out these stocks, taking them higher, helping out the markets. As for what could be ahead, let's check in on a chart that we've looked at before. I know a lot of folks don't like to take a look at the Dow, but here it is in white. We have the Dow continuing to trade at or near its August high. At one point it was above it, certainly above its 200-day moving average. The S&P 500 below it. The question remains, Guy, which one of these two indexes is right? We also have that German DAX that I know you follow above its 200-day moving average. The NASDAQ Golden Dragon Index above important resistance or support. So it's interesting to watch this because it may suggest that maybe there's a little hope for the S&P 500 in the year ahead, if the Dow is right.
I think you found a use for the Dow. Abigail, fantastic work. Thank you very much indeed. Abigail Doolittle, what's happening in the markets? Let's talk about the data, because certainly having an impact today. Two pieces of data out within the last hour. Conference Board numbers very strong. Existing home sales out of the States falling for a 10th straight month in November. Now that extends a record decline, which is clearly being impacted by high mortgage rates. Now mortgage rates have rolled over quite recently. We're now trading at a 3-month low on the 30-year. Let's get a take now from Mark Zandi, Chief Economist at Moody's Analytics, the perfect person to talk to about these numbers. Mark, your read about what's happening here. Is this as bad as the data gets? We've seen mortgage rates coming off fairly sharply over the last few weeks.
Yeah, I think in terms of home sales, I think we're pretty close to the bottom. I mean, 4 million homes sold during the month. That's down from, if you throw in new home sales as opposed and existing, we're close to 5 million home sales. You go back to the beginning of the year where we were at 7. So that's a pretty significant come down in a very short period of time. And I think we are pretty close to the bottom. And that reflects the peak in mortgage rates, which were back a couple months ago when they were significantly north of 7% for a 30-year fix. Now we're down closer to 6%, and I don't think we're going back to over 7 again. So I think we're pretty close to the bottom in sales. In terms of construction, and particularly in terms of house prices, we've got more to go here. But in terms of sales, I think we're at bottom.
So we have a great chart here, Mark, hey, it's Alex, that shows the average weeks of work to pay a monthly mortgage as of the end of November. And that's the bottom part of this chart. It's this yellow line. And it's looking like 2.5 weeks of pay to pay off your mortgage. That seems like a lot. How much does that have to come down before we get some more equilibrium in the market? And I guess that leads to then how low do house prices have to go?
Yeah, my sense is you're right. I mean, affordability has been completely hammered here, and that's the fundamental issue. You know, you mix the high mortgage rates with the previously high house prices. It's just too much to bear. I mean, I think the average monthly payment for a typical for American buying a typical priced home is up to $700-800 from where it was about a year ago, and that's just not affordable. So we need a combination to restore affordability and get demand moving in the right direction again. We need a combination of lower mortgage rates, lower house prices, and rising incomes. And my sense is if mortgage rates come in back to 5.5%, which is where I would expect them in the long run, incomes continue to rise, we don't go into recession, we need about a 10% decline in house prices to restore affordability sufficiently. That probably won't happen until late 24 going into 25. So I think we've got a couple of years here before affordability will get to a place where demand will start to improve again, significantly improve.
Mark, why don't you believe the mortgage rates are going back above 7%?
Well, and I think a couple reasons. One, I think the Fed has laid out a path to a 5% federal funds rate target. That's what's embedded in market expectations. That's what's embedded in mortgage rates. And I think that's the high that they're going to in this cycle. I don't think they need to go higher than that to get inflation back down into their target in a timely way and to avoid an economic downturn. So I think that's the peak in the the federal funds rate target, and that would be consistent with a sub 7% mortgage rate. The other thing is the spread, the difference between the mortgage rate and the Treasury yields, what the Fed is influencing, is incredibly wide, unusually wide for lots of different reasons that are temporary. They're not going to, the current spread is about 3 percentage points on average, it's about half that. So over time, I expect that spread to compress for various reasons we can talk about, and that will make it much more difficult for mortgage rates to rise. So I think the 7.5% mortgage rate we saw back, I guess it was 6-8 weeks ago, that probably will be the peak this cycle.
So what are those factors that contributed to that wide spread?
Well, investors in mortgage securities, they need to be compensated for so-called prepayment risk. So that's the risk that they get paid back more quickly than anticipated. And when you're in a world of higher and very volatile interest rates, that prepayment risk is higher, and they need to be compensated for that. So that risk will come out, will start to decline once it's clear that the Fed has stopped raising interest rates. That prepayment risk will come out, and those spreads will compress.
Mark, why do you think 5% is enough to get it done for the Fed? I've just seen the conference board data come out, 108.3, up from 100. The consumer's feeling pretty good. You take a look at the Carnival numbers today. Take a look at the Nike numbers today. They're pretty strong. There is this expectation that we get a mild recession next year. Let's say the U.S. economy holds up. Let's say that inflation is harder to get down from here than maybe we're anticipating, and therefore the Fed needs to go harder. Isn't there a danger that 5% is kind of the downside here, that actually the upside could be nearer to 6?
Yeah, no, good point. It's my expectation that 5% is sufficient to slow the economy down, get wage growth rolling over, and ultimately getting inflation back to the Fed's target in a reasonably timely way. I think the statistics we've been getting recently are consistent with that view. And we got a great November CPI number, a great October. We're going to get a wonderful December number when that comes out in a couple of weeks. It just feels like inflation, for lots of different reasons, is coming in a reasonably graceful way at this point. Now, obviously, things happen. It could be oil prices spike again for whatever reason. China shuts down again because everyone's getting sick because they ended their lockdown policy. There's many, many things that can knock us off script here, but I think the most reasonable script is that inflation will come in, and it'll be coming in sufficiently by early next year when the Fed has to make a decision about, I'm at 5% now, do I need to go to 5.5 or 6? And my view is they'll get there and they'll decide that no, they don't need to get there, and inflation will come back in.
So then it really then becomes how quickly can inflation fall, which leads me to housing rents. And I'm wondering when we actually see the fall in housing rents really show up in the data, and how quickly can that part of the reading fall?
Yeah, that's key, and that's one of the reasons I'm so optimistic about inflation. With a reasonable high level of confidence, we know that market rents, the rents that are being charged people that are signing leases today, they've suddenly gone weak and down for in part because rents are so high that people can't afford to rent. So you have so-called demand destruction and a lot more supply. The supply chains are easing, and builders can get appliances and building materials. Labor markets are easing. Foreign immigrants that work in construction sites are getting on the job. So getting a lot more properties going across the finish line to completion. More supply, less demand, rents are weak, and that's going to show up in the cost of housing services over the course of the next 6 to 12 months. So by this time next year, the cost of housing services growth is going to be moderating very, very significantly, and that's one reason I feel reasonably confident that inflation is going to be coming in here pretty quickly.
You talk about it kind of coming in gracefully, Mark, but then you listed a whole load of tail risks. Does everything have to go right, i.e. we get no big surprises for your scenario to play out? Yeah,
the way I kind of put it, Guy, is we need a little bit of luck. And when I say that, to your point, we can't get knocked off course here by something else going wrong. Although I will point out, things go wrong, and there's also a possibility things go right. So there's, risks on both sides of this, and we need some reasonably deft policy making. The Fed's got to get it roughly right, and who knows? I mean, it's possible they make a mistake here, given all the uncertainties and the fog of data and everything else that complicates the conduct of monetary policy. So you're absolutely right. I mean, I say this with great intrepidation, and I'm not going to argue with anyone who says, oh no, inflation is going to remain more persistent, and we are going to get hit by something, and a recession is going to occur. That's, very possible scenario. I just don't think it's the most likely one.
No, fair enough. I mean, I got to say, though, supply chains, it's been 9 months, and I'm still waiting for a handle for my fridge. I'm just saying, it's not easy for me, people. Mark, thanks a lot. Happy holidays. Mark Zandi, Chief Economist at Moody's Analytics. Thanks a lot. All right, coming up, Eric Snyder, Wilk Auslander partner and chairman of Bankruptcy Department, will be joining us. Sam Bankman-Fried coming into the U.S., no longer fighting extradition. Now what happens to the creditors? This is Bloomberg.